Hello and welcome. I'm Shaleen Agrawal. We are talking to Mahesh Patil of Aditya Birla Sun Life AMC. Mahesh, thank you and welcome. Mahesh, very quickly, are Indian stock markets overvalued right now?
So that's a very relative question, okay? Because if you look at the Indian markets, they have done fairly well. If you look at year till date, markets are up, right, around 5-6%. Whereas you would have seen that the other global markets, including S&P, Nasdaq, are down anywhere between around 10 to 15% down. So in that context, I think India has outperformed in the last 1 year, and the valuations as a result, if you look at in relation to, say, the other developed markets or in relation to the other emerging markets, because you see a deep correction in the other emerging markets, including China. So they look to be expensive. So compared to historical levels, probably it is around 20-30% higher. But if you look at from an absolute perspective, India multiples, the market is around 8 to 10% higher than the long-term average in terms of the price to earnings multiple or the price to book value multiples. So to that extent, it is slightly expensive, but mind you, the growth also in the Indian markets has been very strong. So in the last 1 year, okay, if you look at Nifty earnings growth has been around 20% growth, which is much superior. So if you compare to the market what it was 1 year back, right, in the same time, the market is up around 7%. But earnings have grown by around 20%. So in that sense, it's actually valuations have come down than what it was a year back, right, when the market reached the all-time high. So the market is no doubt, it is not cheap. It is slightly, I would say, just slightly expensive than the long-term average on an absolute basis. But I think from a long-term investor perspective, if you look at it, the long-term growth trajectory for India looks to be much better. We're expecting that earnings will grow at around 13 to 15% CAGR over the next 3 years. If that is the case, then it is much better than what earnings growth, what we have seen, say, even pre-COVID level, right? During the pre-COVID level, the market Nifty earnings growth was just about 5%. So in that context of better earnings growth and better earnings visibility, I think market is going to be fairly priced at this point in time.
You're talking about the bottom line, 13 to 15% CAGR, is it?
Yes, 13 to 15% earnings growth. That is the EPS growth or the bottom line growth. Yes.
Sure. I'll actually come to the earnings growth a bit later in details. But your point on markets being expensive or not cheap, that was still slightly hedged answer. Are markets in the risky territory valuation-wise for investors right now?
That's what I was trying to convey was they look expensive, right, related to the other markets, but they are not nowhere into kind of a bubble territory or where we think that they are risky because the growth, right, of earnings is fairly okay. Though there are concerns about global growth slowing down, recessions, but even if you factor, we don't see any major impact on corporate India earnings growth. There will be some amount of downgrades. Currently, the consensus is expecting around 17-18% growth in earnings, right, for the next year. I think that number can go down a bit, but I don't think there is a big risk because it all depends on your near-term outlook and the long-term outlook, right? From a near-term perspective, probably the markets look to be the risk reward might not look very favorable because the upside is a bit limited, especially in an environment where we are seeing that global interest rates are going to remain higher for a longer period of time. There is going to be a slowdown in growth. There could be some earnings downgrades globally. And we see interest rates have moved up in India also, right? So the returns, what you're likely to get from the debt funds or even from that has moved up now, right? So they're also looking at an alternate viable. I mean, a year back, right, the FD rates were like below 5%. So a lot of money moved into equity. Now, I think the risk reward is fairly well balanced for equity, I would say, right? And while there could be short-term correction in the market, which is always possible, right? Equity markets always tend to be volatile, and you could see a correction over here. But if you're a long-term investor, you are investing with the next 3 to 5 year view, then I think the compounding earnings which will happen in India, I think that should give you reasonable returns in market, even from these levels. The returns might not be very high than what we've seen in the last 2-3 years, but I think there will be reasonable returns, okay, which is good for long-term investors. So I think the markets are fairly priced, let me put it this way, right? Just to answer your question, it's not highly overvalued.
Sure.
And to that extent, returns could be more moderate.
What are the drivers other than the earnings growth? What is it that is driving the exuberance in the markets right now?
So the Indian markets have done well because the Indian economy recovery from the post-pandemic, we are seeing a steady improvement over there. We are still slightly below the pre-pandemic trajectory, but there are a lot of sectors actually, if you look at even pre-pandemic, are actually doing well. So before the pandemic, we had a problem in the auto sector, right, which had seen a slowdown. Now that sector is reviving now, and we're seeing a steady improvement over there. Banking sector also went through a lot of banking and financial through the whole NBFC crisis. So the banking sector is now looking up. We've seen credit growth now pick up, which was around 5-6% a year back, is now growing at around 16% credit growth. The whole corporate balance sheets are now in fairly good shape. The debt levels have come down. A lot of corporates had delevered in the last 2 years because of strong cash flows and profitability. So the balance sheets are in very good shape. And as a result, we have seen that the corporate NPA cycle, right, the bank NPAs are also at a kind of an historic low. So that sector is looking up. Investments have started to pick up a bit. We've seen that the whole capex, which was down, a lot of investments to GDP declined sharply from a period from 2014 till 2019-20. We are seeing some green shoots and pick up over there, especially private sector capex is slowly starting to pick up in a few sectors. And the government focus on manufacturing, domestic manufacturing, the incentive scheme which the government has launched, the production linked incentive schemes or the PLI schemes, is also seeing a good traction. We see a lot of MNC companies setting up capacities, manufacturing, not only for domestic market, but also for the export market in sectors like, for example, mobile phones, right, in electronics, in auto ancillaries, in pharmaceutical APIs. So that is, again, driving the overall growth. It's not only consumption, but it's also investments which are picking up. If you look at the real estate sector, which was also seen a big slowdown, right, from in the last 7-8 years, is seeing a revival. In the last 1 year, we've seen the whole pickup in real estate sale has been fairly healthy. Inventory levels, which used to be high of unsold stock, has come down. So the whole real estate and housing sector is also now picking up, which used to be actually was a drag on the economy in the last 7 years. Now that incrementally is looking fairly decent. I think after all the RERA and the reforms what we've seen in the sector, I think there is a reasonably fair demand which is coming in. So I think there are a lot of factors which are now contributing, okay, for the economic recovery, and I think that gives us the overall confidence that the recovery in India, our overall GDP growth next year, we're expecting it to be around 6%. At a time when global growth or US will probably see a 0% kind of a growth or a mild recession going through. So that is what I think is giving the confidence that it's time for India actually has come. And also, I think globally, the changes which are happening, the geopolitical changes which are happening in terms of the China plus one policy, right? A lot of global MNC players are looking at reimagining their supply chain. They're looking at alternatives to China because they've seen during the pandemic, the supplies were disrupted. And India is becoming an alternative for that, right? Because of the huge amount of progress which we have done on the trying to reduce our bottlenecks which were there for manufacturing, be it logistics costs, which used to be very high earlier, around 17-18%, that's come down to around 13-14%. And the government is coming with a new infrastructure logistics policy to bring it down to around 8%. So that will improve India's efficiency, right, on the manufacturing side, which was kind of impacted earlier because of the logistics cost. Also, the taxations, the tax structures also have been, in the last two budgets, we've seen that tax rates have been brought down, corporate tax rate, and especially for new industries, new investment is brought down further. So I think all these things should aid manufacturing in a big way. And structurally, I think biggest strength for India would be the whole the working age population. I think Indian demographics are favorable, right? India will be adding the maximum number of people to the working class over the next decade, and that will provide the kind of resources or the manpower for supporting this kind of growth in the manufacturing side. So, and demographic, India is still a young population, so the aspiration levels are going up. We are seeing that the disposable income in India is likely to improve. In fact, per capita GDP has crossed around $2,600. It's an inflection point where we've seen that globally, a lot of consumption, of discretionary consumption of items starts to pick up. We saw that in China around 15 years back. I think we are at that stage. So I think all these factors gives confidence that the long-term outlook looks good. Near term, there are challenges. There is some kind of slowdown, but I think if somebody is looking at equities from a long-term perspective, I think that is what will drive earnings growth over a longer term.
How much long is long term?
So when I say long term means say at least say 3 year, right? I think when investing in equity,
Sure.
at least 3 to ideally a 5 year should be a time frame if you are putting money into equities. But I think over a 3 year is a what period you should be at least looking at, because then you would be able to look beyond the near term challenges. Otherwise, from a short term perspective, a lot of concern, as you rightly said, right? There's high inflation, though inflation is coming down, interest rates are higher, there is talks about global recession. So all those are challenges from a short-term perspective, but I think if you look beyond that, then things are looking not that bad.
Sure. I have a couple of brief questions about China plus one and the US GDP versus India GDP. We'll come back to it if we have the time at the end of the interview. Let's move on for now. Inflation trends, if you see both CPI and WPI, you spoke about corporate earnings. We have seen that the input prices are still higher and the fall in inflation is mostly on the output prices. There are indications that companies are still not passing on the complete costs. So is there any concern that the margins may be under pressure going forward for companies, or will they pass on costs so the prices will increase and hence the demand will or the sales will fall?
So what we've seen is that in the last year, there was a sharp increase in commodity prices, right? And it was very, very sharp because of the Russia-Ukraine crisis. And we saw oil prices went up, metal prices also went up, food prices went up, palm oil prices went up. They are now cooling down. So in that scenario, I think the companies were not able to take a big price increases because it's very difficult to pass on that kind of increase to the end consumer. So they have been taking on a incremental basis. And now the costs are coming down. We've seen oil prices are corrected, the palm oil prices are corrected sharply. Again, that should benefit the FMCG companies. Metal prices are also down. So I think that benefit will slowly start to flow in the next few quarters. So I would expect that the margins should improve, for companies. Passing on price increases now, I think it all depends on the competitive intensity in each and every sector, right? Like, for example, in the consumer durable space, we have seen that in the air conditioners, for example, the competitive intensity had increased suddenly, and their ability to take price increases is much lower. But other consumer companies, I think they are taking small price increases. So I think you should see actually a margin starting to improve from a lot of sectors like automobiles, like FMCG sector, right, which had seen margin pressures. I think you should see sequentially those improving.
When we spoke about valuations earlier, and you said that there is a healthy earnings growth visibility, and hence the markets are kind of on a firm footing. But are there any risk factors that the investors must watch for right now?
Yeah, so I think it's not going to be a smooth sailing. I think there will be ruffled waters. You would see volatility. Again, the impact of high interest rates globally, especially in US, Europe, the regions, to what extent it leads to slowdown, to what extent the recession fears which are there, how long they are likely to be there. I think that will also decide to some extent our exports, right? Because our GDP growth, while we have done much better, but in a backdrop where global growth is significantly lower, you would see that impacting our growth. Also, I think oil is, we have seen that there has been some pressure on the current account deficit, when oil moved up to around $100 plus. Because in an environment currently where your exports are slightly weaker because of global and your domestic growth is strong, imports are strong. So the current account deficit can move up. I mean, it had gone up to around 3.5%. It has now cooled down because oil prices have come off, right, to below $80. But if oil prices again move up, say around $100 plus, then there is again likely to be further pressure on the CAD. Then that will put pressure on the rupee, and that could impact the flows. So I think that is one clear risk at this point in time, okay, which one needs to look into. And apart from that, I'm not seeing any major risks, okay, which are there on the horizon. Obviously, geopolitical risks continue to be there at the background. Okay, what's happening? We saw that Russia-Ukraine crisis. To what extent it continues? Okay, we know tensions, okay, in between China and Taiwan. So what happens over there? But I think those are the risks which are still unknown risks. I think which there's no point trying to worry too much about that.
Sure. You said about correction and returns being reasonable from these levels. How much correction can we expect, if at all, and what are the levels that one should enter at?
It's very difficult to predict, okay, what level of correction would be there. We've seen that even in a bull market, we've seen correction as high as around 25-30%, and markets continue to move higher. But I mean, I would say that the markets, if there is around a 10% correction in the market from here, then the valuations will start to look fairly reasonable, right? The slight overvaluation which is there compared to long-term, that will look start looking a bit attractive, and I think that will be a very good level, okay, for somebody who is waiting on the sidelines to enter into the markets, to re-enter the markets. But having said that, I think we know markets tend to surprise you, right, on both sides. So one should be prepared for that. But I think even if there is a deeper correction in the market, I don't think it will be long. It will be very short-lived, right? Because as I said, the overall sector outlook for most of the sectors is at the margin looking better. And I think flows-wise also, if you look at it, domestic flows have been fairly steady.
Yes.
Right. There are a lot of investors who are, I mean, this is a market which has climbed a wall of worry in a sense. A lot of investors are waiting at the sidelines also to enter into the market and not even able to participate because they were worried about the broad negative narrative which has been there, right, in the last 6 months. And any correction, I think, will get bought into, right? So you will find support to the market from investors who are waiting to enter the market and still sitting on cash. So I would not expect a deeper correction. I think 8 to 10% correction would be a good level, okay, for a long-term investor to really put money into the market if he's been waiting for that.
Sure. I mean, 8 to 10% is also quite a good enough discount if one can get it. My question is, should those waiting on the sidelines wait for it, or should they start deploying money now?
That's a very good question, actually, because people have been waiting for correction for a long time, right? And markets have, not now, but even during COVID time also, right? I mean, markets corrected, but people then waited when they rallied. So I think it's would not be wise to wait for a correction. But if somebody is wanting to put in fresh money, it's advisable to do it then through an SIP route, right? I mean, that is for a normal. Even if lump sum investments have to be done, that can be done through the STP route, which is systematic transfer route, and spread that over a period of 3 months or 6 months time frame. So I would say that looking at the market levels where there are valuations, while the long term it still looks good, but near term challenge, it would be better to spread out that rather than making a lump sum investment at this point in time. And people who are incrementally putting their savings through the SIP, then that should continue. They should not stop, right? Because I mean, that's what we've seen, right? Investors who have continued to do their SIP, they have actually benefited because markets continue to rally, right? And if they had stopped their SIP earlier, okay, they would have missed on that. So I think SIP investments on an incremental investment, I think that should continue, and one should not stop that at any cost.
Sure. Any particular pockets of outperformance which you see are ripe for investments right now without worrying too much about valuations or levels right now?
In the market, I think what we like are the domestic facing sectors, right? Because India growth is going to be reasonably okay. and we've seen consumption has been fairly steady. I mean, it got impacted during COVID. That is slowly coming back. Rural consumption, okay, which was weak, is likely to slowly improve because rural farm incomes and this thing have been improving steadily. And the government is also likely to really getting into elections 2 years down the line. Okay, they would like to see that the rural economy does well. So sectors linked to that should do well. And banking, as I talked earlier, okay, that is a sector which looks reasonably priced compared to its historical multiples. We are seeing improvement in the overall credit growth, which has been fairly good in the mid-teens. The credit cycle is looking very good, right? The corporates NPAs, okay, which were a big challenge for the banks, they are at record low levels. And that as investments pick up, I think banks should do well. So banking and financial services sector, some of these consumption sectors, especially rural consumption. Again, investment cycle, manufacturing also investment cycle is picking up. Some of the industrials, capital goods sector look good, but yeah, very expensive at this point in time. So one should be slightly cautious, but otherwise the outlook there looks good. Other sectors like, for example, real estate, right, where we are seeing steady kind of a growth over there, and the outlook there also looks fairly positive. Some of the, I mean, if you look at the PSUs also as a pack, right, some of the utilities, they offer a good reasonable margin of safety. Okay, still reasonably priced, and can offer a steady upside. Okay, these will not be high growth stocks, so one can't expect a very large appreciation, but the risk reward there looks fairly good. So I think there are some of the sectors where I think the outlook as well as the valuations are okay.
You spoke about banks. Banking index has been touching new highs day after day. You think still reasonably valued?
Yeah, so bank Nifty has done well, okay, new high, but it's also been driven on the back of fairly strong growth in terms of the earnings. If you look at the profits of the banks in the last 2 quarters, especially after the rate increase, we've seen the margin, the NIMs, net interest margins of the banks have improved. So, I think it's in line, okay, with the underlying improvement in the earnings. So I think despite the bank Nifty or the bank touching an all-time high, the valuations there are only marginally higher than the long-term average. So it's not like overly priced on a valuation. If you look at the price to earnings multiple or a price to book value multiple, it doesn't seem to be overpriced.
Very quickly, Mahesh, PSU banks or private banks for next 2-3 years?
So in a wherever the cycle is good, and what we're seeing currently, the overall trade cycle is good with growth picking up. Everything does well, right, in that cycle. And PSU banks are also doing well. Their numbers have been fairly strong. They're sitting on a good amount of SLR deposits now. With interest rates have moved up and they're kind of peaking out, they could get some gains down the line. So the PSU banks have seen a good rally. Again, they could do well from a short-term perspective because they were undervalued. The valuations were really cheap over there. But from a 3-year perspective, long-term perspective, I would still say the private sector banks, right? PSU banks will still be a trade because of the cheaper valuations and the fact that your credit costs are going to be very, very low. But I think longer-term growth and market share gains of private sector banks, I think that will continue. So from longer-term perspective, if I'm investing, I would still look at good retail private sector banks, which are also investing in technology, because that is going to also be a differentiator in terms of how we are using technology.
Mahesh, looking at the interest rates and inflation and the monetary tightening right now, what is your advice for investors for asset allocation for the next 1 or 2 years?
So I think now with interest rates having moved up, right? So that should also be looked as an alternative, right? In terms of asset allocation, especially debt funds, right, which can offer now reasonable returns. We are seeing debt funds giving returns of around 7.5% or so, which was not the case a year back, right? So last year, a lot of money moved into equities big time because interest rates were very low. Now I think where the equities are placed in terms of the return, the risk rewards are looking well balanced. So I would say that from an asset allocation perspective, I think you should allocation to equity should be in line with your target allocation. One should not go overboard over there, right? If your target allocation based on a risk profile is around say 50%, I think one should be somewhere closer to that. Is what I would advise. And any correction or dips in the markets, one can increase that as equities tend to be more attractive. So debt funds, I think, are now being considered. We have some of these target maturity plans, okay, which are there, which can be an interesting alternative to look at. So I would say that be more kind of balance in your asset allocation. Okay, somewhere closer to your target allocation, and look at the mix of both debt and equity in your portfolio at this point in time. And the fact that interest rates are now somewhere near the top, and you don't expect, I mean, it'll probably be another 25 or 50 basis point rate increase, but if you look at the bond yields, they're to a large extent pricing in. So the last year, okay, when interest rate move up, a lot of the bond funds gave negative lower returns because there was a mark-to-market loss. Now, as in the next 6 months, we expect rates to peak out. So then you can enjoy the carry, okay, the high interest rates without being worried too much about mark-to-market loss on the debt portfolio. So I think that's how I think one should approach in terms of the asset allocation.
Just one final question. If one were to get into debt investments right now, would you advise them to start pairing their debt investments in next 1-2 years when the interest rates start falling? Or do you advise them to stick with the investments that are made today?
It all depends on your overall asset allocation. I think one should stick to the asset allocation principle. Interest rates, okay, as actually normally what happens is that as interest rates peak out at higher levels, and as they start to move down, if at all, there is actually capital, there is a mark-to-market gain which you make on your bond portfolio if you're investing into a bond, right? So in that scenario, I think it makes sense, okay, to continue to hold on, okay, to your bond portfolio. Again, it's a relative game, right? If equities kind of correct in a scenario and the valuations there start to look attractive, like valuations, then obviously one can move some portion of the debt part because debt would not give you extraordinary return, right? They will give you in a particular band. So then one can move it to equity. Otherwise, I think one can continue to hold on, okay, to the debt portfolio. As long as it is in line with the target allocation, okay, what you have intended based on your risk profile, I think one can look at and not try to just move, right, because interest rates are to move down because you can capture in the mark-to-market gains over there. So that's, I think, how I think one should look at. I think not be in a hurry, I would say. No? But obviously, if there is a correction, okay, in equity, I think that can, because that always is a kind of a liquid asset, okay, which can dip into and build up the equity portfolio, okay, when the market gives you the opportunity.
Your colleagues in the fixed income department will be very happy with your answer.
Yeah, so we have been actually starting to push our debt products also. We see there is an opportunity now because retail investors had moved away from that, and I think some of our bond funds or dynamic bond fund are looking as interesting alternatives, which I think over the next 3 to 6 months would start looking more attractive as the overall carry in these funds starts to look better.
Sure, Mahesh, we'll end the conversation here for today. There are several other threads which we'll pick up in our next conversations, hopefully. Mahesh Patil, thank you so much for joining us today.
Thank you. Pleasure talking to you.